Derek Layton, and I'll be presenting this webinar with my friend and colleague, Leslie Mondesir. In this webinar, we are going to give you an overview of our new marginal cost of funds tool and some deposit trends we have been seeing within our district. Just real quick here, just a little bit about myself and Leslie. I started out in the banking industry in 2014 at a local community bank here in Topeka, and joined FHLB in 2018 as a lending analyst, and then was promoted to lending officer in 2020. One of my main goals is to assist members with current and up-to-date funding strategies, as well as providing education to our members, so that way you guys can maximize your FHLB membership.
Good morning, everyone. My name is Leslie Mondesir. I'm the Member Solutions Manager here at the bank. I joined the bank in 2016 and support the sales and lending teams to help identify opportunities with our members, kind of understand member challenges. I also support the strategic planning process, and prior to that, I worked at an investment banking firm located in Chicago.
Leslie? Just real quick, guys, every webinar I do like to start off with our mission statement. And that is FHLBank Topeka makes a difference by providing reliable liquidity and funding to help our members build a strong community. And as a lending officer and Leslie, the Member Solutions Manager, our goal is to be your trusted financial partner. One of the main goals of FHLB is to help our members find ways to strengthen your balance sheet, as well as provide other services that will help you excel at serving your customers and building those strong communities. We are in constant communication with our membership and can provide assistance and advice on a wide array of topics, not necessarily just liquidity. So if you have any questions or are interested in what we hear is working within our district, please don't hesitate to reach out to us at the lending desk or your account managers. Just real quick here, just a couple of the key benefits of being a member of the FHLB. The easy use funding. We have our online draws for our overnight letter of credit, or the overnight line of credit, our low cost funding, and of course we also boast that AAA credit rating from rating agencies and our regulators. And again here, just a couple funding uses our members use us for. That is contingent liquidity, kind of our main purpose. Our asset liability management, interest rate risk, that is a very big topic right now with the Fed rapidly increasing rates. Any sort of, special, one-off, match funding events you need, we can certainly help you out with that as well. And real quick on here, just because, yesterday we just had a recent rate hike, we did want to ask you guys kind of a polling question to kind of get, your view or your responses on that, and that is just kind of when do you guys think the Fed will either pause or start lowering rates? That can be, so the second, third, or fourth quarter of next year, or 2024 or beyond. If you want to take a couple seconds there to let us know what you think, that would be great. All right, and kind of now moving in to the actual webinar today, the marginal cost analysis. Marginal cost is simply calculated. Sorry about that, guys. We're going to do the results here. So a lot of you think second quarter 2023 is majority. That kind of is my personal opinion as well, just from everything I've been reading. I kind of hope that they do start, at least put a pause on the rates there. All right, and now we'll get back into the actual webinar, what we're here for today. And that's just the marginal cost analysis. And simply put, marginal cost is calculated as the change in interest expense divided by the change in your balances. And, the marginal cost analysis is a very hot topic right now. And, with the Fed rapidly raising rates, Some of your competitors are raising rates on non-maturity accounts, while others are running new CD specials. You guys are kind of, wondering, do I need to keep doing this to keep your deposits? Do we need to start raising rates like our competitors? Just a couple of things to keep in mind when you're going through this process is what percentage of the depositors won't leave if you keep rates unchanged or lag increasing those rates. What percentage of deposits will move from lower paying accounts into the new promotional product or the product you're raising rates on? Are the new funds attracted worth the cost of repricing your deposit base or cannibalizing existing deposits? And this here too, just kind of a checklist for your marginal costs. Kind of like that the SWOT method, essentially your strengths, weaknesses, opportunities, and threats. The first step in here is research. Kind of make sure you have a good understanding of all your alternative funding sources, such as the FHLB. Know your liquidity sources, dollar term limits, and then the rates that they provide you. And also understanding the demographics of your potential depositors or existing depositors. The millennials are kind of taking over the workforce nowadays, and kind of seems like they are not, interested in CDs as our traditional customers. So you gotta wanna, weigh those pros and cons there. And then another thing here is perform an annual review of your CD-only customers. More than likely, those customers are just chasing a rate to park their money, so you want to do an annual review. See if it is worth raising those rates to keep those customers, because really, how much value do they provide your bank? That's always something you want to review. And then pricing. When you are looking at pricing a new CD or new CD special, always price that to the wholesale funding curve. You can even use our advance rates, to price those CDs, and obviously compare and contrast those rates for reasonability. And then the analysis, kind of the big thing of it too. And one, kind of thing that I think is very, very important that you guys need to be doing if you aren't already, is tracking the new and old money. When you guys run a CD special or increase the rates on your CDs or money market accounts, whatever it may be, that is very important. That way you can actually tell and see how effective, that, promotional rate or that, rate increase was in obtaining new funds. And again, just kind of, develop a deposit segmentation report, include, factors kind of like I mentioned earlier, age, rate, non-sensitive, large versus small balance accounts, and kind of everything like that. So this, is kind of quick overview. Make sure you're kind of taking all these steps to see if it is worth, actually increasing rates on your CDs or your other accounts.
All right, so here is a snapshot of a district deposit pricing dashboard that we have developed to kind of keep a pulse on the pricing activities going on within our bank and credit union members, as well as institutions that might not be a member but have branch locations within our district, including even like your Wells Fargos and your big banks that do compete, or that you all compete with within the district. What we've done is we've looked at the district, the top quartile, so we've looked at all the branches within our district and look at which rates they're being offered, and have calculated the top quartile. They have a district average. I would compare it to the national average, and you can see there that we have an average for some more digital-only banks, and that their pricing is quite a bit higher, as they have to be a little bit more, tend to be a little bit more aggressive. Here we're just looking at money market accounts, a few tiers, as well as just some short-term CDs, 1 year and 2 year. This does include all banks and credit unions, and this data was as of October 28th. We also take a look at betas, what percentage and rates financial institutions pass on to customers, and that's based on the change in Fed moves throughout the year. It does not include yesterday's 75-point basis hike yesterday. You can see the cost of time deposits are increasing at a greater degree than the non-maturity accounts, as institutions are looking to bring in longer-term funding, in part from increased competition for deposits, both with traditional institutions as well as more non-traditional banking-related entities, and the Fed raising rates. Like Derek mentioned, a deposit consideration for pricing would be to consider pricing those CDs to the wholesale funding curve for CD-only clients, and then maybe adding some basis points for relationship additions if you have a greater share of their wallet. Deposits continued to move out of institutions during the third quarter. Liquidity positions retreated for the second consecutive quarter, and growth in liquid assets during 2021 was erased in the past 6 months, on average, as institutions have used excess cash to fund strong loan growth, while security portfolios generally remain in unrealized loss positions. We expect this will contribute to an increased competition for deposits as funding and liquidity needs grow, and the deposit rate environment, either as banks and credit unions attempt to retain and or attract new deposit funds, so playing offense and defense. The bottom line will be impacted by growing competition for deposits and rising costs. Here we're looking at the shift in deposit funding mix over the last few decades. You can see the significant shift in time deposit funding from 50% about 15 years ago now to about 20%, and then the reverse, so non-maturity accounts increased from 50% to 80%. And during the prior cycle, we didn't really see them converge like we did historically. And then with the onset of the pandemic, it just, all that money received from the stimulus went straight into the non-maturity accounts. And these were mostly concentrated in money market and savings accounts. Credit unions have experienced a very similar trend compared to their bank peers. We don't have them graphed here today, but you would see a similar trend. We're not expecting to return to traditional funding mix in the future. Historically, like I said, they converge and shift through both rising and falling rate environments, and we just haven't seen that. Analyzing the impact of deposit migration is essential to managing the cost and interest rate risk through this current cycle. We pushed through the prior cycle high of Fed funds upper bound 2.5% in September, and then moved higher with the Fed hike yesterday, the upper bound reaching 4%. Non-maturity accounts continue to hold at all-time highs, even as the Fed continues to tighten. Will we have a shift? Will it begin, or will it at all? Technology has made these money market and savings accounts more spendable, and they're insured. And as a result, these balances may be more sticky as they earn a competitive rate of interest. Or because of this, will there be an outflow, continued outflow of banking system deposits? Derek mentioned some generational questions. Will younger generations move away from time deposits, or do they even know what CDs are? I've seen some industry analysts kind of question, are the CDs a dying product? And need to look for alternative options, the younger generations will look for alternative options in investing, while older generations may keep more excess liquidity on hand. The pandemic accelerated the digitization of banking services among the industry, adding yet another layer of competition among financial institutions and non-traditional players. Although deposit growth has continued over the past 25 plus years, the rate of growth has not kept pace with the growth of bank assets, leading to the utilization of wholesale funding to help fill that funding gap. oh, there's a question there. What is the 1 week, 1 month, and 3 month columns? So if we go back here. So we're looking at the change in average rate being offered on a 1 week basis, a 1 month, a 3 month, and then a year to date basis. And then we look at the betas for each of those accounts for on a 1 month, what's the 1 month beta, 3 month beta, and then on a year to date basis.
Yeah, and just real quick, so that, like that 1 month change, for example, you see there, guys, that is, you know, October 28th and then a month back, to September.
So it's taking, yep,
September 30th.
so the change in the 1 month rate of the deposit product, and then there to the right, you can see was a 75 point basis change, and that's how they calculate the beta. Same for the 3 months and then year to date. And again, this does not reflect yesterday's rate hike. Here's a different look at rates. So we looked at time deposits over time of the funding mix. Here's a look at rates over time. This goes back to August of 2009 when S&P Global, who we use as our data provider for all of the deposit rate information as well as call report information. S&P Global acquired RateWatch. And so you can pull in, you're subscribed, or RateWatch can pull your deposit rates on a weekly basis. We can see those changes. You can see the 10th district average are the solid lines on both graphs. Top graph are non-maturity accounts, bottom are CDs and share certificates. On a monthly basis, going back to 2009, I said that. And then the average rate offered across the nation are those dotted lines of the same color. The average rates offered on time deposits dropped materially since the Fed funds rate returned to the zero bound in March of 20, and then floored early this year. The decline in share deposit products was much more gradual following the Great Recession than the almost immediate drop seen at the onset of the pandemic. 10th district rates have also generally been higher than the nationwide average, pretty consistently over the years. You see that there to the right of the graph, product rates have started to accelerate over the past couple months. We showed earlier how maturity accounts have had higher betas than non-maturity accounts. This is also reflected here, but that doesn't necessarily mean we've seen a shift yet into more term products. So we haven't really seen the balances actually move into those higher rate offerings. And before I move on, I'd like to add that this comparison here over time, we have available within our marginal cost of funds analysis that Derek and I are going to walk through here in a bit, and it can be adjusted to show an individual institution, state average, MSA. There's also additional account types that we can show. We didn't show them here because it would look like a plate of spaghetti. Here's the next slide. This is a snapshot now. I know we're about 17 minutes in, so I'm going to get through this quick so we can get to going through the tool. Here's a snapshot in time of rates. So back in 2018, 4 years ago, is on the left. The lines represent the yellow lines, and then the blue, light blue kind of dots on the right. Those are your standard CD offering products for banks and credit unions across each of these state markets. The diamonds, so on the left are the dark gray, and on the right they're the blue, darker blue. These are specials that are being offered. You can see they're kind of fairly short term, and this was late in the rate cycle. In 2018, there were a lot more CD specials being offered than there are today. I'm not sure if that's a result of the shift in non-maturity accounts and time deposits, how that's continued to widen. But I just thought that was interesting, the difference between 4 years ago and then today. And then I just quickly mentioned that having a pricing strategy that is not based on the competition as the primary factor in how you set your deposit rate. Much of the market follows benchmark or competitive pricing to set rates versus using any models of price elasticity or measures of deposit flows in response to changes in rates. To avoid overpaying for deposits, pricing strategies should reflect the value of the relationship, as Derek mentioned, broad and deep versus single use, as well as the all-in cost of marketing, acquisition, and servicing rate. You can see historically that banks and credit unions have loved the use of CD specials to attract funding. And I'm going to turn it over to Derek to talk about our marginal cost of funds analysis.
Yeah, thank you, Leslie. I think it's, us as bankers, we always do look at trends and historical analysis. So, that was a bunch of good information. So thank you for that, Leslie. So now what we're going to be showing you guys is our new actual marginal cost of funds tool that actually Leslie, had a huge hand in developing. We're kind of going to go through the actual steps of what you guys will actually see when we send you this analysis. So kind of and again, Leslie was kind of talking to earlier, all of these rates and everything you see on here are not going to reflect that rate hike we had yesterday, so just kind of keep that in mind when we're going through this. But the first page you guys will, kind of see when you request one of these analysis is just this, historical or the average rates, within our district, within your institutions, your competitors, your peers. And one thing that's kind of cool about this tool is that we can actually, say you're competing with, certain banks, down the corner, around the block, we can select, certain peers that you want to see, their average, rates and everything like that, or as well as just, what area you're in. For example, on this one, you can see, and this is an actual sample of a member. That's why we have some stuff blurred out. But then you can see this, market area for this member was in Kansas City. And then those, fields you see on there are the average, rates in Kansas, the Kansas City area, and then, it's the U.S. Average rate. And this here, kind of breaks down, this certain members, their deposit composition compared to the district that they're in. So here you can see I'm pretty heavy into the CDs and then the transactional accounts. All right, and this is kind of the good stuff here. This is what we actually input into the field. And as Leslie kind of said too, all of this data that we get does come from S&P. So it's all call report data that we pull in. And all of the like gray fields you guys see on here, those are customizable. So we can, it's automatically going to pull in all of your call report data. But if you want to change, your rates, your deposit composition, whatever it may be, all those gray fields are, things that we can play with, work with you guys to see, the exact result that you guys are wanting. But so real quick, in this example, this institution, they are looking to acquire $5 million in new deposits at the 18-month term. And then the CD rate that they are thinking about offering is 3.33. And then you can compare that to taking down an 18-month advance with FHLB at 4.99. And one thing this tool does as well, as we'll kind of see later on the next slide, is it does, as you can see there, the stock position of this current member, it'll take into effect your dividend account that you guys have with us.
And then Derek mentioned that this is based on call report data. So a few considerations regarding marginal cost of funds analysis is these product costs are weighted averages. A limitation is that we assume rates and balances move at one time and stay static versus some interest rate ramps used for budgeting purposes. We also assess on annualized interest expense. So to reiterate that back testing should be done on a monthly or regular basis to evaluate actual results of the CD offering versus what is projected, similar to how you budget and do your interest rate risk modeling.
And just kind of real quick on the bottom section of this tool in those gray fields. You can see, this tool is analyzing, a 2% change or maturing / repricing in your transactional money market accounts, and then 3% for CDs, or 6% for CDs and 3% for savings. And then, I'm sorry, we're gonna have to go kind of quick here, guys, through this, but we'll try to get you all the information on this tool. So again, this is the results page. And as you can see here, again, we're looking at $5 million in new funding, comparing the new promotional rate of 3.33 to an FHLB rate of 4.99. And kind of, long story short here, you guys can see the new marginal costs that you guys would essentially get if all those assumptions on the page before were true. It would end up costing you an extra $286,000, providing an effective rate of 5.73. And then when we compare that to the FHLB costs of $233,000, you get the effective rate of 4.68. And then this here, it does the dividend benefit. One thing I did want to point out on this is on our monthly rate sheet. Right now, you guys are probably seeing a dividend benefit of 23 basis points. On this one, I believe it's showing that'd be a 31% or 31 basis point discount. The reason the discrepancy between those is this calculation is not taking into effect the alternative reference rate of the IOBR. And then again, down there at the bottom, the recommended strategy and benefit, just showing you guys would save over $52,000 or 105 basis points by taking down an FHLB advance rather than offering that promotional rate of 3.33. And then this here, I kind of just wanted to show you guys, because again, like I said, we can play with all these numbers however you would like. On here, I just changed the CD, maturing or repricing percentage to 20% compared to 6%. And that obviously on this next page, we can see how that affects the rate. Your effective rate goes all the way up to 6.35 in that case, and then end up costing you $317,000. And again, just kind of down at the bottom, showing the best strategy is FHLB advanced strategy there. And then now, real quick here, Leslie is going to talk about this tool. What I just showed you is a more simplified version of this tool, and then this tool actually is very, very detailed. It can actually do a lot of things for you, and that's what Leslie is going to talk about here.
I'll quickly walk through here. So, like Derek mentioned, the deposit portfolio and pricing analysis has increased scope and capabilities to help you analyze various scenarios and strategies associated with the potential restructure or repricing of the deposit portfolio and the resulting impact on your cost of funds. These scenarios can be related to earnings pressure from the current cost of funds, competitive pressures that may impact the flow of deposits into or out of the institution, or the decision to pursue wholesale funding as a replacement for some of the higher cost deposits in an institution's portfolio. These scenarios can allow for comparison of retail funding strategies versus wholesale funding strategies, or a blend thereof, when evaluating the need to support asset growth, fill the funding gap, when deposit growth is not keeping pace with loan growth. The tool can also be used to demonstrate the impact of various funding strategies, not just in a rising rate environment, but also in a falling rate environment or a zero rate environment. And currently, we all have the goal to reduce interest expense in a rising rate environment. So with Derek's example, it was a CD comparing just the CD specifically to a wholesale funding strategy. Here we can expand on that. The first part here to the left, those first several gray columns, so the four, are exactly the same as what you showed before. Here with rate adjustments, provides an option to raise rates across select accounts or the entire portfolio, in expectation of future rate increases or to combat a more competitive deposit rate environment. Can estimate the expected movement of each account type in a rising rate environment versus expected the rise in Fed fund rate, and reflect management's assumptions of how fast their deposit rate will follow market rate. It allows you to evaluate the impact of where rate-sensitive accounts may be at risk of leaving the institution, and whether that's non-maturity accounts or term accounts that are approaching maturity. We can leave rates as is on non-rate sensitive accounts and then raise rates to retain at-risk accounts. We can raise them across the whole portfolio or just portions. And again, like Jared said, this is customizable to your portfolio. We can just do different tiers of money market accounts. We can break out certain segments of the portfolio that might be more rate sensitive than others, as opposed to just having these broad buckets. This net new money column here, we can make adjustments for deposits flowing into or out of the institution. Inter-portfolio migration, the movement of deposits from one bucket to another. Pro forma balances and rates and cost of deposits, again, on an annualized basis. And then the green on the right, the change in cost and percentage change as well. Another option within this tool is you'll see there's an option for, you can offer or run 3 different promotions, whether those are CDs or even money market type accounts or other non-maturity accounts. We have the option to replace rate-sensitive funding with FHLBank funding. And then here's our deposit migration worksheet, where we can adjust the flow of deposits into and out of promotions, into and out of all the accounts that you decide to list. I think there's up to 11. So it's not, those are customizable. So not just migration to promo 1. You can say migration to a tiered money market account, and where you might get transactions or savings accounts or even CDs that might move into those types of accounts. Again, there's 3 options, like I said, and then to the right, we would summarize the options. Replace rate-sensitive accounts with FHLBank funding. One difference between the simplified version and this version, it allows you to break that FHLB funding up into 2 different tranches. So whether you put a portion short-term and put a portion into term, it allows you to do that, and then it'll calculate the dividend impact first on tranche A and then tranche B, and takes into account your current stock position. We also have the ability to adjust whether or not you do a stock purchase for additional required stock, or you net fund the advance of the stock. There's our 2 tranches, and then there to the left in the green, you have your pro forma stock position and outstanding credit obligations. The analysis with deposit portfolio analysis, we do have 3 scenarios that we can run simultaneously, whether that's, for example, scenario 1 may be a retail-only deposit pricing strategy. Scenario 2 may be wholesale only, and then scenario 3 could be a blend thereof. And we can compare to find the optimum strategy from the perspective of the lowest cost alternative. The use of these analytics would provide your outcodes and board committees documentation and support for your funding and pricing decisions, and is useful in tracking the overall results and effectiveness of your funding strategies. I think part of building a strong core deposit strategy is building an efficient retail pricing strategy. It requires retail tools such as segmentation of retail markets, like Derek mentioned, differentiation of retail products, also requires marginal cost analytics that we walked through today, including the tracking and incorporating the analysis into your decision making. considering a blended funding strategy of deposits and wholesale sources to manage the volatility and your margin pressures may provide a more effective strategy from the perspective of pricing efficiency, availability of funds, knowing what exactly you want and being able to get it quickly, and interest rate management. And here you guys have a copy of the slides. We listed out potential strategies and considerations for today. I did mention some of this quickly as was kind of describing the capability and scope of the tool. And then I mentioned that tool can also be used in falling rate, zero rate environments. So here's a few of the kind of examples or scenarios that can be run when rates may be headed down.
Thank you for that, Leslie. Guys, I know we are running kind of long here, but, you know, I appreciate you guys sticking with us. You know, we do realize that is a lot of info that we just threw at you guys. This tool can do a whole lot of stuff for your institution. So, you know, if you do have, if you do want us to run this analysis for you guys, you know, please feel free to reach out to, you know, myself, Leslie, or your account managers that you see on the screen here. You know, we would be happy to run these tools for you guys. And then just kind of, again, I know we are kind of running a little bit late, guys, but we do want to give a couple minutes here. If you guys do have any questions, please go ahead and throw them in the Q&A or the chat window, and we would be happy to answer those for you.
Mark, I see your question. Yes, we can send you the slides.
Yep, yeah.
If you didn't receive them already, feel free to reach out and we can get those sent over to you.
All right. Again, you know, guys, thank you for sticking with us. Hope you enjoyed it. And again, you know, please reach out, you know, again, to Leslie or myself and the Rams, if you would, you know, like this analysis ran for you guys, or even, you know, especially when you're considering your next funding option, you know, we would love to be a part of that decision with you guys.
Thank you, everyone, for joining.
Yep, thanks, guys. Have a good day.
Have a great day.